Hello everyone, my name is YONGLIN. Today my topic is the changes in the term structure. And the example I'm gonna use is the operation test from the Fed. So firstly, I separate my presentation into 5 parts. The introduction, theory explanation, case analysis, further thinkings, and lastly the conclusion part. So firstly is the introduction part. So first, I'm gonna talk about the basic theory, which is the term structure. And this term theory is showing the relationship between the yields of funds with different maturity and the maturity period at one specific time point. So for the perspective of correspondence, since the yield of maturity of the zero coupon bonds is equal to the market spot interest rate of the same maturity, the term structure at any time will be function of the interest rate level and maturity. So therefore, the term structure of the relationship between the yield to maturity of the zero coupon bond and its maturity can be represented by a curve, such as downward sloping, upward sloping, and horizontal. So there's a graph on the right hand side, which is by myself, and I just want to show the shape of the curve. So there's like 3 shapes. So there's no data on it because it's drawn by myself and I only want to show the shape. Um, so it's easy to think about like the shape. So not only those 3 types, but also more complex ones. So there's gonna be like the combination of those 3 types into one. So this is the most complex one, and there's also like two two combine 2 type of curves combined together. This is also the more complex ones. So basically the changes in the yield curve reflected the relationship between the maturity yield of bond and its maturity. To be more accurate, this is the difference of interest rate performance of a bond in short term and long term. And and secondly is the case study. So I'm gonna use the term structure operation test from the Federal Reserve starting from 2008. And so since 2008, United States applied quantitative easing by 2 rounds to try to adjust the economic recession. So the first round, starting from October 2008 to June 2010, which the Fed purchased approximately 1.725 trillion US dollar in the government bond, mortgage backed securities and other assets. And then it's the second round. And this round is starting from August 2010 to June 2011, when the Fed purchased about 0.6 trillion US dollar of long-term government bond. And then on 21st September 2011, Fed announced that in order to further stimulate economic recovery, it plans to launch a 400 billion US dollar operation test until June 2012. So, I'm gonna like further talking about the meaning of operation test. This is basically like, for example, to sell the short-term government bond and buy the relatively like amount of long-term government bonds in order to extend the overall maturity of the government bonds asset without expand the size of balance sheet. So looking for the perspective of yield curve, this kind of operation is equivalent to bending the far end of curve downwards. So this is why the operation twist was named. So the next part is the theory explanation. So this theory can be divided into 3 sub-theories. And the first one is called the expectation theory. So for this theory, the presumed assumptions are firstly, the market is complete and efficient. The funds can freely flow. There's no transaction cost and taxes. There's no default risk. There can be fully substitution between bonds that have different maturities. The expectations of the future short-term interest rate levels from the investors are consistent and unchanged. The aim of investors to maximize the profits. So the aim is very obvious, is to maximize the profit. So based on that, the shape of the yield curve is determined by the future short-term interest rate that the market expected. So for example, the upward yield curve indicate that the market expected the short-term interest rate is rising. So the further interest rate will be higher than the spot interest rate. So there's another example that the concave down yield curve indicate that the short-term interest rate will be rising at first and then fall back. So this is basically the first theory. And then the second one is the liquidity preference theory. For this one, the presumed assumptions are, so firstly, the investors are risk averse. Secondly, expectations and risks can be all affected the term structure. And then the liquidity of short-term bond is higher than the long-term. So based on that, the investors are aimed to reduce the risk by selected more short-term bonds with strong liquidity, while for those long-term bonds with less liquidity. Investors requires a certain liquidity premium as the compensation of opportunity cost and risk. So only if there is like interest rate of long-term bond is very high, like even higher than the short-term bonds, the investors have the incentive to buy the long-term bond with high risk and illiquid. Therefore, the normal and common yield curve can be indicated as the upward sloping yield curve. So this is basically the second theory, and then the third theory is the market segmentation theory. So the presumed assumptions are, firstly, the bond market of different maturities are separated and rarely affected by the bond market of other maturities. Secondly, the investors of different investment needs forms the market. So in the market, there are different investment needs. So thirdly, all investors are rational. Lastly, all investors have different preference of bonds of different maturities. Based on that, the whole bond market can be divided into 3 markets: short-term markets, medium-term market, and long-term market. Each of these markets are relevantly segmented and will rarely affected by other markets. The supply and demand of each market should be determined by the spot interest rate of bonds in corresponding market. Like for example, the short-term interest rates will be determined by the relationship of supply and demand in short-term bond market. So it's the corresponding one. So this is basically the theory. And thirdly is the case study, case analysis. So the Fed conducts the operation test with intention of changing the term structure. The usual bond yield curve grow with maturity convexity, and which means that the maturity increase, the growth rate of the term premium will be decreased, and expectation of people about the short-term interest rate and their uncertainty in the long-term future will be stabilized. But however, after the Fed implemented 2 times of quantitative easing, although long-term interest rate falls, but the short-term interest rate falls more significantly. It caused the yield curve of U.S. government bond to become concave upward because short-term interest rate is close to zero. This concave upward interest rate term structure caused the U.S. dollar to become the source currency of carrying trade funds. So this is leading a huge outflow of short-term U.S. dollar funds and affected economic recovery. Yeah, and basically at the same time, the long-term interest rate that are too high will cause insufficient government investment motivation and will discourage the long-term development of economy. And so the Fed plans to sell 400 billion US dollar of short-term and medium-term government bond to remaining maturity of 3 years or less by June 2012, while purchasing the same amount of medium-term and long-term government bond with remaining maturity of 30 years, 6 to 30 years, which is like the long-term ones. So this is basically what we said in the introduction, how the operation test was done. Yeah, and the operation does not increase the basic money supply, but they also adjust the term structure of interest rate, reduce the expectation of people from the future short-term interest rate, expectation, and their uncertainty. And increase the short-term interest rate in the money market and encourage society to engage in relative stable medium-term and long-term financing. And this will promote the stable expectation from people of future economic situation, and it's conductive of economic recovery. Yeah, and basically this is what they did. And next is the further thinking. This slide talks about the actions that the Fed took. So at first we need to mention that the investors are paying closely attention to the flattening of the yield curve. So the reason is that if the yield curve is very flat, then this is a very good indicator of an economic slowdown. So for the Fed, they significantly decrease the interest rate, quantitative easing, and operation test. So those are all the actions that they took, which they simultaneously sell short-term bonds and buy long-term bonds to help reduce the cost of borrowing and boost the economic growth. Actually, we have to say that they are success. so they successfully diminished the unemployment rate to a very low level, and the capacity limits are already or at least about to reach. So firstly, to decide to, I think Fed need to decide to reserve the traditional quantitative easing and restore the short-term interest rate to the normal level before the economic crisis, after they reach all this like unemployment rate and capacity limits. And then I think they need to change the focus on the um uh conventional rate to the unconventional measures that they taken. So this is basically what they took. And this side is the action that the Fed might take. And it's very obvious that every country want their economic at normal level. So to become normal, the Fed tend to rise the interest rate regularly and transparently slide to the shrinking the uh, balance sheet. Then with the maturity of US government bond, the continuing of reducing the Fed balance sheet is closely related to monetary policy, and the Fed has yet to solve the distortion that they cause to the yield curve by using the operation test. And I think the next step of the policy basically is to less depending on the increasing of interest rate. To aggressively unwind quantitative easing and reserve the operation test. This is very important, and as we said before on the last slide, the market is on the past slide. The market is paying highly attention on the yield curve. They are also paying attention on its effect, and not only the market or the investors, but the Fed also consider about it. And people believe that the Fed should strengthen the policy to sustain the growth, cancel the stimulus measures they took to unconventional policy in order to decrease the risk on the balance sheet, and purchasing the short-term asset and selling the long-term assets. The Fed will reach this policy goals and retighten the curve by doing those. This is what people expect, and I think it's very reasonable to think like that, because that is one economic cycle. So this is basically what the Fed will do in one economic cycle, and then we come to the last part, is the conclusion part. So this time, as I said in the past one, the people may have the expectation that the Fed can reach the better operation and achieve important goal to minimize the unemployment rate, price stability, and moderate long-term interest rate. And I want to say that the fact is, operation test seems to be very risky. However, we can see that the Fed handled it very successful, and the U.S. economy is continuously growing after using the operation test. So we can see from this graph on the bottom that the after those the part that shaded into gray, which represent the economic recession. After that part, it's continuously growing to a small peak. So this is what the Fed did. I think is very success. Since it handled it very beautiful. So this is what basically I'm gonna talk about in my presentation. And thanks for listening. Mm, yeah.